We've got Jigar Shah, who's Senior Vice President and Head of Research at Kimeng Securities. He joins us on the show from our VT studio. Jigar, to begin with, all eyes on the Fed tonight in terms of what it will do, whether or not it will push ahead with QE. Most people believe not. How are you positioning yourself in the current environment?
Well, I think our house view is that there is not likely to be any QE as such. I really don't have much to add on that. Basically, I think we have to see India from more a point of view of what's happening internally and what the government is committed to do over here. As we probably come to an end of the state election, presidential election, a lot of all these political events, probably we should see more urgency to step up those pending reforms which will help the capex cycle to revive and bring back investor sentiment, and also government show some kind of commitment on the improving the fiscal deficit situation. So I think all those things are more important as events, as I see it, than anything else from a point of view of our market.
But Jigar, wanted to come to you with some of the cement stocks. What would you do now after reading into the Competition Commission's order, given that, we are talking about a penalty of close to 8% of the average 3-year turnover?
Well, I haven't yet been able to get a copy or, read in detail, but from whatever is the information available in media, if this is true, then definitely, for a company like AC or Ultratech, this will wipe out 40 to 50% of FY12 earnings. That is something which was anticipated. I don't think it is completely correct to say that, there was no idea about this kind of a situation in the marketplace. What is more important is that how does that impact the future of the cement price fixing? And if that really puts pressure on the prices which are ruling currently, which are quite firm, that will be more important, and that will force analysts to revise their forecast downwards. So my view is that cement companies as such are under the pressure of oversupply in the short term, and also there are issues relating to demand because of the slowdown in the economy. So we have had a view of sell on the cement stocks for the past year or so, mainly because the valuations are expensive and the price premium cannot sustain. So we maintain that view, and we still recommend a sell on ACC, Ambuja and Ultratech.
Right, and Jigar, how are you viewing the infrastructure pack? I'm not sure you picked that up, but we just had a story a short while ago that some of the power sectors are looking to revive movement on their projects. At least 2 projects are working on refinancing some of their existing loans. Do you believe, to the extent that there is some traction once again emerging on the power front, you would revisit those, that sector?
Not really. I think if you look at the key factors which are affecting the power sector, that includes the coal FSA, that includes the overall coal pricing, and thirdly, the assurance to the power producers that they will get the return on investment. I don't think any of these factors are sorted out, and I think government needs to really make some concrete decisions in order to plug these issues, because other than that, you cannot really be sure of what happens to the generation companies in particular, and the new projects will have a lot of headwinds, and the equipment companies are dependent on generation companies. Distribution and transmission companies to some extent will be less affected. I would say particularly a company like Power Grid does not have any problem at the moment. So, we continue to like those kind of companies which are, having less amount of troubles to face, but particularly the generation companies and the companies associated, with equipment supply like BHEL, etc., we continue to be negative on them, and we reiterate our stance of underweight on the power sector and the infrastructure sector.